Debt mutual funds, in simplicity, works like a loan. The principle is the same. Loan is something which all of us are familiar with. In a loan, there is a lender, there is a borrower. A lender gives money to the borrower uses the money for whatever purpose he needs it. The money is typically given for a fixed duration, 2 years, 3 years, 5 years. Basically an agreement between the lender and the borrower for how long the money has been given. During the currency of the loan, during the tenor or period of the loan, the borrower will keep paying interest on regular duration. And at the end of the period, the borrower will return to the lender. This is how a loan works. If for whatever reason, if the borrower is not able to repay to the lender, then that loan is going into what we call it as a default. And the lender has the right to move against the assets of the borrower. This is the principle of the loan. Debt mutual funds also work on the same principle, but with some differences. In a debt mutual fund, instead of a loan, you have something called as a bond. Bond works in principle as the same as a loan. There is a lender, there is a borrower, there is interest payment, which in bond terminology is called coupon, and there is a defined maturity date. And all the other rights also remain the same. Where a bond differs from a loan is a bond can be traded the way you buy and sell shares on a stock market. And SEBI, which is the regulator for markets, set the regulations whether it is bond trading or mutual fund. So bond can be bought and sold. Not exactly what you do with a loan. At least loans are typically not bought and sold. A bond is easily bought and sold. But otherwise, it works exactly like a loan, where there is a lender, borrower, regular interest payments, and a maturity date. Now, in a debt mutual fund, how it works is, debt mutual fund will collect money from investors like you and me, use that money to invest in the bonds issued by corporate entities such as government, banks, financial institutions, or any other corporate entity. Example of a corporate entity can be Reliance Industries, for example, or a Tata Steel. So, debt mutual fund will collect money from investors and invest it in the bonds of these corporate issuers. The rest of the things, everything works exactly the same. There is regular payment of interest. At the maturity, the money has to come back. If the money does not come back, the bond goes into a default, and the debt mutual fund can move against the assets of the borrower on behalf of you, the investor. This is how a debt mutual fund works.